Hello everyone, how are you doing? Today we are going to talk about lecture 2. Alright. So, accounting made easy, lecture 2. This is so easy, dude. Let's go and let's get started. So, today we're gonna talk about the change in basic accounting equation. As we knew from the last or the previous lecture, that we have something called the basic equation, which is assets equal liabilities plus owner's equity. And so we have a change that's called the delta. So delta assets equal delta liabilities plus delta owner's equity. How is that going? Let's check an example. Here we have example. Number 1. If total liabilities increased by $15,000 and owner's equity increased by $5,000 during a period of time, then total assets must change by what amount and direction during that same period? Let's solve it together. So this is the equation. All we have to do is to put the numbers in and start solving. Okay. So if total liabilities increased by 15,000 and owner's equity increased by 5,000, let's go start it. Total liabilities increased by 15,000, so we will write 15,000 plus owner's equity increased by 5,000. 15,000 plus 5,000 equal 20,000 positive. So this means that we have increased the change in total assets by 20,000 during a period of time. Then total assets must change by what amount and direction during that same period? 20,000 decrease, 20,000 increase, 25,000 increase. Oh yeah, 20,000 increase. Okay, because he requested what amount and direction, is it positive or negative during that same period. Then we have to focus on this. Okay, that's called the delta, the change. Number 2, let's try to solve it. If total liabilities increased by 14,000, okay, so we will remove the 15 and add 14 during a period of time, and owner's equity decreased by 6,000. Okay, so we will add 6,000 in brackets. And then we have 14,000 minus 6,000, which gives us 8,000 positive, not negative. So what we have now, let's complete reading the question, please. Equity decreased by 6,000 during the same period. Then the amount and direction, increase or decrease, of the period's change in total assets is an 14,000 increase, 20,000 increase, 8,000 decrease, 8,000 increase. Yeah, because it's positive, we will choose 8,000 increase. Okay, let's remove this. We're gonna need to write it from above. Okay, then we have this change matrix. Okay, I have to say that change matrix is very essential, and this equation is we're gonna use it only when the question includes the beginning or ending balances. That's where we use the change matrix. Otherwise we don't use this method at all. This method is very simple. Horizontally and vertically. Horizontally we write the basic accounting equation, assets equal liabilities plus owner's equity, and vertically it's the equation itself. Beginning of the equation plus change what happened in the equation, and the ending, what results do we have. So we write it like this: assets equal liabilities plus owner's equity as horizontally, and vertically beginning plus change equal ending. And we start to write the beginning. We will note it like we'll give it like a number 1 equal 2 plus 3 plus change 4 5 6 and ending 7 8 9. Let's put it into action, please. Okay, so I wrote it here: assets equal liabilities plus owner's equity, beginning plus change equal ending. Let's check the question. At the beginning of the year, Mustafa Company had total assets of 800,000 and total liabilities of 500,000. If total assets increased 150,000 during the year and total liabilities decreased 80,000, what's the amount of owner's equity at the end of the year? So we have to like structure. Let's make it like structured. Where is the beginning, what's the change, and what's the end? So let's try by the beginning. Let's try to take the numbers for the beginning stage. At the beginning of the year, Mustafa Company had total assets of 800,000. Then beginning, here is the beginning, and we will write assets 800,000. Right. And total liabilities of 500,000. Alright. If total assets increased, oh, that's a change. Alright. Let's go to change. If total assets increased by 150,000, I will write 150,000 during the year, and total liabilities decreased 80,000 pounds. Okay, 80, because it's decreased, so I will put between brackets 80,000. Alright. What's the amount of owner's equity at the end of the year? Okay, so he wants this. Owner's equity. He wants the owner's equity at the end of the year. Okay, let's start. Let's start solving it. Assets equal liabilities plus owner's equity, very simple equation. 800,000 equal 500,000 plus what? Easy, plus 300,000. Simple mathematics. Okay, change 150,000. 800, we have two known and one unknown, so we can get the one unknown. 800,000 plus 150,000, what this will give us? 950. Alright. 500,000, okay, minus 800,000, which is 420,000. Easy. Alright. So now we can get this. $950,000 equal 420,000 plus 530,000. Correct. So this is the ending that we want to get from the beginning. This is a solution. Okay, we should fill out all the info, but if only needed. In that case, I will fill this info in order to make sure that you have understood well. Okay, 300,000 plus unknown equal 530, which is easy. 230. That's it. Okay, let's check for the answer. We need 530. Oh, here it is, number C. This is the steps. and this is the answer. Let's try another one. Step by step, and we will use calculator on this one. Okay, please be patient and open up your calculator. Okay, I'm going to do it with you. Easy way. Okay. At the beginning of the year, Mustafa company had total assets of 800,000. Alright. We started our company by 800,000 assets. Alright. That's good. And total liabilities of 500,000. Okay. Let's think about it like a story. Like we borrow money from the bank, for example, for 500,000 pounds, and that's a liability. Okay. During the year, the total liabilities increased 100,000. Alright, that's a change. So we increased our liabilities by 100,000 pounds. Okay. And owner's equity decreased 70,000 pounds. Alright. $70,000. Okay. Yeah. Let's try to do we have any other inputs? Owner's equity decreased 70,000. What's the amount of total assets at the end of the year? So we need this. Okay. Let's try to solve it. 500 plus 300,000 will be 800,000. Right. Good. Let's get those two. 500 plus 100 is 600. 300,000 minus 70,000 will be 230. Okay. So what do we have here? 100,000 plus or minus 70,000 will be 30. Okay. So 800,000 plus 30,000 would be 830. Okay. So sorry for the noise. So that's 830,000. Okay, let's try to check it. 600,000 plus 230 equal 830. That's right, correct. Okay, so 830 is the final answer. Let's check it. Alright, we solved it right. 830,000. Okay, we are moving to the most important things about our lesson today. So we have two things. We have like 5 things we knew from the last, from the previous lecture, which is assets, liabilities, owner's equity, revenue, expenses. Those are the 5 categories which help us to establish the 4 other statements, which is okay. Can you see my hand? Yeah. Income statement to provide the profit and loss. Owner equity statement to check how's our capital going. Is it growing? Is it decreasing? And the balance sheet, okay, which states that for how long can we stay in the market. Okay. The 4th one is a cash flow statement. Do we have enough liquidation to liquidate the company and give the other partners their money or not, and can we survive in the short term or not. Okay, this is the 4 statements that the 5 categories that I mentioned will help us to develop. So let's start by revenues and expenses and how the change in both can affect the financial statements. Okay, for revenues. If revenues increased, that means we are making money, we are selling, right? So the assets will increase because we are making money. We are selling and taking money in any form. We can, the customer can pay by cars, for example. It's not. He can pay by cash. He can pay by gold, anything like that. So, if we sell and our revenue will increase, that means our assets will increase. So, any increase in revenues will result in increase in assets, which leads to the owner's equity will be increased, as we saw in the previous statements. That means that if we made lots of revenue, and that made net income, which means the owner's equity from the beginning will change to owner's equity ending with a more value. And that means if we increased our assets, that means we decreased our liabilities. Right? It seems logic. What is revenues examples? Such as sales. We made sales, rent revenue. Let's say we rent a small apartment which gives us every month $100,000. So every single month I have a revenue of $100,000. My assets are increasing. My owner's equity is increasing. So rent revenues, interest revenues. I lend someone money and he pays it to me and he's giving me the interest. Fees revenue, commission revenue. Commission revenue is just like I'm selling, like I'm working in a housing. Okay, I'm working in a real estate company and I sell houses. So I take my commission. It's called the commission revenue. Fees revenue. Alright, that's for the revenues. Expenses. Okay, let's ask another question, please. Are we going to memorize all of this? SR, sales, rent revenues, interest revenues, fees revenues. No, you don't need to memorize it all. You just need to know that we refer to all of these as an SR, sales revenue. When do we record revenue? So if we sell something, alright, and the customer didn't pay us, he still didn't pay us, he took the service or a product and didn't pay us, should we write the transaction while we don't have the money yet? Yes, you should, because you did it. And so if you did it, if you made that service, if you provided that service, and if you sell that item, you should write it in the financial statement, whether or not you took the money. When doing, performing, providing, or rendering service or selling goods, whether it was collected or not, you should record it. Let's move forward to expenses. Expenses is opposite to revenues. Okay, so for example, I had to pay the receptionist, giving her the salary of the month. Okay, so that's an expenses. The car needed maintenance. That's an expenses. I need an ongoing money to maintain my project. That's an expenses. Anything that we pay is called expenses. Alright? So expenses will lead to decrease in assets, because if I have like money and I'm literally wasting that money in any form, that's called an expense. So it will lead to decrease in assets and thus decrease in owner's equity, and thus increase in liabilities, because Like if I wasted $10,000, I will have liability more by $10,000. I need to get that money that I wasted, that I paid. I need to get it. So if I waste like 50,000, it will be more liability and more liability. So that number that we provide for the business in order to start and in order to maintain its position and maintain its operating system is called expenses. All right, and that amount that we pay is literally gonna increase on us, and we need to, in any firm or organization, we need two things. We need to decrease the liabilities and increase the profit. Okay, so we need to minimize this number as far as we can, as long as we do a profit. Okay, expenses example, such as wages and salaries, advertisements, renting. We pay for the rent, we pay for advertisement, interest, like we took a loan and we need to pay the loan plus the interest rate, utilities, taxes, used supplies. And we will gonna talk about used supplies in details in the next slides. When do we record expenses? It's the same as revenues. Whenever you do expenses, when consuming or using an asset or getting services, whether it was paid or not. In that case, you are the person who's gonna need that service or asset from the other person. So for example, you requested an advertisement and you didn't pay for it. Okay, you didn't pay for it, so still you will have to put it and record it in the financial statements. That's a great one. That's a great slide. That's the change in revenues and expenses. We have something called RED, R-E-D. R is the revenues, E is expenses, and D is the drawings. Okay? Let's define that as have you seen that photo? Yeah. Okay. This photo, it's like a one way. It's a one way. That means the R or EOD is just increasing. It would never decrease, right? As this instrument is only increasing and resetting, increasing and resetting. You can see it decreasing, right? Like how they calculate the electricity bill, like this way. So RED is only increasing. So for revenues, it's increasing and will lead to increasing in owner's equity. As we make more money, our owner's equity is getting higher. The E is expenses, which is if increased, that means our owner's equity decreased. We are paying from literally the money that we provide to the business. So if the expenses increased, automatically the owner's equity decrease, and liabilities, boom, increase, of course. These are drawings, and drawings, like the owner of the company, every day he draw cash from the company. So that means he is decreasing his own owner's equity. At the end of the accounting year, how can we stop this and start the cycle again? At the end of the accounting year, we establish financial statements and we reset it back again to start from the beginning. Okay? Note the difference between assets and expenses. Assets provide future benefits. Expenses provide current benefits. Let's give you an example of that. I will give you two examples. The first one, let's make it like story wise. Okay, so if I requested Uber, okay, or InDriver, or anything like that, any program like that, and I paid the right fees, okay, which is for example like a £50. That's an expenses, right? I used the Uber drive for something related to the job I need right now to be delivered, uh, to go to the other firm, or to reach that person or anything, right? I need to do a trip related to work. So as expenses, I paid the Uber driver £50 in order to make the job done, right? To reach the place and provide the service needed, or sell uh, the product, whatever. That's a current benefit. But what if I bought the car? I bought the car. That's an asset. This car will provide me with future benefits. I can ride it. Any other employee can ride it, and thus we can rely on it for future benefits. It's not just now. No, I own the car. Okay, that's the difference between assets and expenses. Okay, I give you here another example about papers. How can an asset turn to expense? For example, if we used that car, okay, let's suppose that we bought that car and we used it, okay, until no maintenance can be done. So it turned from being an asset, a reliable asset that we work on, to something that we can't even do anything about it. It's totally garbage. We paid maintenance on it, we paid spare parts, we paid everything on it, and we cannot further do any thing about that car. It's totally garbage now. So as example here, another example, I give you a papers. When we purchase supplies in a form of papers, and we took that papers and we used it. After using that papers and printing on it, it turned to be an expenses. We will throw it away in the trash. We cannot use it again. It's like a one-time usage. Alright? That's a very important slide. That's a very important topic. You can think of how assets turn into expenses in the form of usage. That will broaden your horizon. Okay, we have examples here. What are revenues exactly? Is it the cost of assets consumed during the period? No. The cost of assets consumed during the period? No way. There is no cost about revenues. What cost? Gross increase in owner's equity resulting from business activities? That seems to be logic. I will put it in my mind. Number C. The cost of services used during the period? No way. The cost of services used during the period is called expenses. I will exclude it. Number D, actual or expected cash outflow. We are not going to talk about cash outflow and cash inflow. That's another topic. So I will stick with B. Number 2, if services are rendered for credit, then assets will decrease? No. If services are rendered for credit, liabilities will increase? No. Owner's equity will increase? Yes. Liabilities will decrease? No. Okay, so I will stick with C. Why? As we mentioned, if we provide the services, whether or not it's paid in cash or paid in credit, we will have to write it in the financial statement, and we will have to check for the revenues. What will happen if the revenues increase? If the revenues increase, the assets increased, and the owner's equity increased, and the liabilities decreased. That's in your mind. Whether or not you're gonna be paid by cash or credit today or tomorrow, it doesn't matter. This means that your owner's equity will increase. Number 3, if supplies that have been purchased are used in the course of business, then okay, let's read again. If supplies that have been purchased, I bought supplies, are used in the course of business and are used this supplies, then liability will increase and asset will increase, owner's equity will decrease, owner's equity will increase. Okay, let's get reminded about the expenses. What will happen if expenses increased? If the expenses increased, that means the assets will decrease, and thus the owner's equity will be decreased. Right, that's right. So I will choose owner's equity will decrease. Okay. We are getting deeper. Okay, that's a question 4 and 5, and use the following information for questions 4 and 5. We have here revenues 140,000, Mustafa capital 1/1/2020 70,000, equipment, expenses, cash, Mustafa drawings, supplies, accounts payable, accounts receivable, and here he requests Mustafa assets on December 31, 2020. Okay, let's try to solve this, please. Let's try to solve it together. Okay. All right. Okay. Alright, guys. Let's get started. Assets equal liabilities plus owner's equity, right? Alright. That's called the basic equation, and we provide it in the balance sheet. For now on, let's simplify it. Mustafa assets on December 31, 2020 are. What are the assets here? Okay, let's calculate the assets, please. We have equipment, Mustafa capital, revenues. Is revenues an asset? No. Is equipment an asset? Yes. So we have equipment for £40,000. Equipment for £40,000. We have cash for £35,000. Cash £35,000. Cash, equipment, Mustafa drawings, supplies for 5,000. Supplies. Sorry. Yeah. Supplies for 5,000. Account payable, account receivable. Also, it's an asset. Account receivable. 15,000 pounds. It's an account receivable. Alright, let's try to figure out whether or not. What if you forgot about account receivable? You just eliminate that and check for the answers instead, and you're gonna find it. Equipment for £40,000, 35,000 cash. That's 75,000. And 5,000 is at 80,000. Alright, what do we have here? 80,000. Oh, we have 80,000. And for the account receivable, it's for 15, which means 95,000. I will go with 90. With 95,000, I will go with it. Oh, right, yeah, that's right. Account receivable is defined as an asset. Okay, for number 5, Mustafa's owner's equity on December 31, 2020. Now he requested the owner's equity on December 31, 2020. That's another thing. Okay, owner's equity. How to get the owner's equity? Can you remember that? Yeah, we can remember that. Let's try to start out by the first one. It's called an income statement. Okay. Let's call this a foster company. Mustafa company, I'm sorry, it's called Mustafa company. Mustafa company, let's try to solve it fast. Alright. Income statement. On the end of the year, on December 31, 2020, and we start by doing our table. Let's imagine that we have done a table here, please. And let's start. Revenues minus expenses. It happens. Okay, revenues minus expenses minus equal. Let's try. What are the revenues provided here? It's 140,000. What are the expenses provided here, please? The expenses provided here is 125,000 in between brackets. Okay, equal. Revenues are more than expenses, so it will give us net income. Between brackets is called profit. 15,000. So we have a net income or profit of 15,000. Let's move ahead to the next one, please, which is owner's equity statement. We will do the same here. Stuff a company, owner's equity, owner's equity statement on the end of the year in December. Yeah, let's do it. Let's do it. Capital beginning plus net income, which will give us the capital ending. Alright, what was the capital beginning? Mustafa capital on 1/1/2020, that's the beginning, was 70,000, and the net income was 15,000. Capital ending now is 85,000. Alright, okay, so 85,000 minus, we have a drawings? Yes, we have a drawing. So capital ending minus drawings to get the current value we need. So 85,000 minus drawings, 10,000 would give us 75,000. So I will go with C, answer C. We have another way to solve this, another equation, which is that mouse is going to kill me. It's moving alone. Okay, we have another equation to help you solve this. It's called capital beginning equal or capital beginning plus or minus E minus D equal capital ending. Okay, let's try to put into action, please. Capital beginning is £70,000 plus revenues 140,000 minus expenses 125,000 minus drawings, which is 10,000, equal, let's put it calculator, let's use a calculator. $70,000 plus 140,000 minus 125,000 minus 10,000, which will give us again the same amount, which is 75,000. So there are two ways to solve it, like the two ways I provided here. Okay, let's check this. Use the following information for questions 6 to 8. Supplies, revenues, operating expenses, cash, accounts payable, net income, net losses. Okay, net income, net loss is revenue minus expenses. Revenue is 23,000, operating expenses is 12,000, which is 11,000. Alright, that's an easy one. Okay, net income, net loss is determined by income statement, revenue minus expenses. Ending owner's equity is, okay, the same way. I'm gonna give you this as a practice to do it. Total assets, yeah, take this as a practice, and let me know your solution in the comments below. Okay, this is easy one. Yeah, okay. Number 11, arms liability on December 31, 2020. Okay, let's check what's the assets and what are the liabilities. Screw cleaners has the following balance sheet items: cash, cleaning equipment, cleaning supplies, used supplies, salaries, drawings, notes payable, account receivable, notes receivable, prepaid, advertising, accounts payable, and so on. So let's define each one, whether it's asset or liabilities or owner's equity. For the cash, it's a completely assets. Cleaning equipment, it will help me to provide further operations for long term, for the future benefits for the company. So it's an asset. Cleaning supplies, something I will use in the future, assets. Used supplies, as we mentioned, the two examples, the one for the cars that we used, it became like expenses, and the paper that we already print on it and we no longer can use it, that's called used supplies. Once it's used, it's expenses. Salaries, of course, it's expenses. Any drawings would be related to owner's equity. Okay, and we put it here as a sign of minus. Okay, notes payable is a liability, which means I have taken a service or a product, but yet I didn't pay it. Okay, and thus notes payable is like a form of check or notes that says that I have to pay that amount in that specific time. That's called a notes payable, or it's a form of a check or other things that prove that you need to pay that amount. Okay, that's a notes payable, it's a liability. Account receivable, that means as a company, I provide the service to another company, and yet I didn't take my money, and he said that he will transfer the money into the firm's bank account, and yet it's called an account receivable. So, as we said earlier, anything I provide with any service or product I provide without getting paid in cash, I have to um, write it in the financial statements, and it increases the assets. So account receivable is an asset, notes receivable is an asset, prepaid advertising is an asset because I already paid for it. It's a prepaid. Okay, I prepaid for an advertising, and that advertising will help my firm in the long run. Okay, focus on this point. If this item listed here gonna give you credentials in the future or gonna help you firm grow, that called an asset. Accounts payable. Okay, receivable is an asset, payable is a liability. Any receivable is an asset, any payable is a liability. Rent payable, I have to pay for the rents. Liability, I have to pay someone and transfer the money into the other firm's account. That's a liability. Rent, of course, it's expense. Capital, it's just an owner equity. Okay. SR, that's revenue. Let's give you a summary about what we said earlier. That's a very easy summary to know. Okay. Assets, liabilities, owner's equity, revenues, expenses. That I need you to know that assets, what we need to focus on right now is just 7 sorry, yeah, just 7 assets: cash, account receivable, notes receivable, supplies, equipment, car, prepaid expense, like a prepaid rent or something like that. Prepaid expenses. Okay. Liabilities: account payable, notes payable, unearned revenue, AP. Owner's equity, it's just one thing includes in the owner's equity. It's just the capital. Okay. And revenues and investment increases the capital, and expenses and drawings, E states for expenses, D states for drawings, R states for revenues. E and D, expenses and revenues, expenses, drawings. Expenses and drawings lead to decrease in the capital. Revenues, SR, like what? How can you notice that that's a revenue in the examples? You will see do a service, provide service, perform service, service rendered, billing customers. All of those are examples of revenues. Expenses like wages and salaries, utilities, rent, advertisement, insurance, use, supplies, interest. When you read any of these statements, you should record service revenue as R. Revenue increases, then owner's equity increase. Any payable is liability and any receivable is asset, as we said before. That's lecture 2. What you need to focus on, understand the concept of how asset turns to expense, how asset is different than expense, what are the examples of assets, liabilities, owner's equity, revenues, and expenses, how to start doing financial statements, the basic ones, and what are the 5 factors and 5 items that help us establish the financial statements, and related disclosure, how to write the related disclosure. You will find it in the previous lecture. Okay guys, hope you enjoyed this lecture, and we will move forward to the next video soon. Thank you guys. Counting made easy. Don't you ever forget that.